Hello, this is Dylan Moore and Nima Bajor of I Read a TV coming to you today. It is July 14th, 2023. And we are here to talk about why the mainstream economic narrative is completely bunk and completely fake. And the reason we want to talk about it is because in our modern world, most people's worldviews get inextricably intertwined with some sort of economic view. And the argument that we're making is that the economic view that almost all of us are given, regardless of the various flavors that it comes in, are just, they're not just like not quite right. They are so completely off the mark, they don't map to reality in any way whatsoever. And what that does is, for issues that come up, we get stuck obsessing about issues that aren't actually issues, and we become blind to the issues that are real issues, which means we become easily manipulated when it comes to this bunk mainstream economic story. And it's been a while since we made an economic show, so we want to sit down and really look at what doesn't make sense about the mainstream narrative, and honestly several offshoots of the mainstream narrative. And we're going to do it really looking at, we're not going to read the article, but we're going to be breaking down the article by Professor Richard Werner. He's got quite the list of titles and accreditations and accomplishments, but I think we've talked about it before, but I think the probably the most succinct thing that I could say about him is he's the only person who has ever done an empirical test of the banking system to figure out how the banking system actually works. As opposed to just theorizing on it, which is what most economists have done since day one, which is why we get ourselves in this dorkily bunk situation of understanding economics. So, Nima, before we get started, there it is. Let me share that screen. So there's Professor Richard Werner. He's from Germany, so it's, I guess, Richard Werner. Yeah, Werner. And Nima was like advising the central bank and the government of Japan during the Japanese economic crisis, and I guess he regularly, or at least at one point, used to regularly advise heads of central banking, including Ben Bernanke during the 2008 crash. So the guy's, he's up there in the economic world, to say the least.
He's up there, and he's also shunned.
Yeah, which is why we like him, right?
Right.
So this is from an article. What was the damn title of that article?
Yeah, I was just going to ask you, where's the article?
Where's the article, Dylan? Where is that article? I sent it to Nima before this. Let me pull it up.
Oh, I thought you sent me. Yeah, I didn't see you sent me that.
Okay, let's see if my Dylan screen share is working.
There.
What do you see now? Not what we need to see. Can you pull it up?
I see myself on infinite loop.
Yeah, we don't want to see you on infinite loop. So this is an article called "Shifting from Central Planning to a Decentralized Economy," which anybody listening to the show should like the sound of that.
Music to my ears.
Music to our ears. And this starts off with him talking about the central banking narrative. And we're not going to go in here and read this. I've made some notes that have summarized it. But because this is definitely something, it's fascinating, but it's definitely something, this article is something you want to like sit in a quiet corner and slowly read and digest. We're going to be making a more flashy version of that. But essentially, there's been a national policy, or a group of national policies in Europe, North America, and Japan for the last 40 years that have been pushed by the central banks in these respective areas, which is why Professor Werner refers to it as the central banking narrative. And because the central banks have supported this narrative, academia has supported this narrative, and because both have, the mainstream media supports this narrative. So everything that you hear in the mainstream everywhere, where it's from the government or it's from academia or you're turning on the news or whatever, it's in some way going to be supporting this narrative. And Professor Werner doesn't say this, but we'll say it. Austrian economics, to a large degree, actually supports this narrative, even though Austrian economics puts forth that, we're the guys that challenge the narrative. We argue that MMT is what's challenging the narrative, and even though I've never heard MMT or modern money theory come out of Professor Werner's mouth or in any of his writings, everything that he seems to be saying is lining up with what we've been talking about with MMT. So there are 5 pillars of economic dogma that the central banks seem to put forth. And I'm going to go over these in a much quicker format than Werner has here. And then we're going to break down why they're completely bunk, and then maybe even look at why that might be the case, that these ideas seem to continue being proliferated. So the first is interest rates are the main policy variable to move an economy. And this is like the loudspeaker on the street corner that constantly gets blared out, right? Like, we need to increase the interest rates to slow down the economy. We need to lower the interest rates in order to stimulate it, right? And this is obviously something we've talked ad nauseum on the show. But what we've pointed out is that this appears to be the opposite of the case. And not only is the case the opposite, the cause and effect seem to be opposite, right? So the mainstream narrative is when you increase the interest rates, that makes money more expensive, so that cools down the economy by slowing growth. When you lower the interest rates, that makes money cheaper, so growth happens easier because it's easier to get that money. It heats the economy up. In reality, what we see is, first of all, the cause and effect are backwards, where the economy either heats up or cools down, and then the interest rate adjustment happens after the fact, right?
Right. Another empirical analysis that Werner has done is looking at that supposed cause and effect relationship between interest rate and I think inflation.
Right.
And we're always told the central bank is the captain of the ship of inflation. When they raise the rates, then they clamp down on inflation. When they cut the rates, then they encourage inflation. And Professor Werner concluded that that's not the case, but it's more like whenever the inflation goes up, the central bank follows by raising the interest rates, and when inflation goes back down, the central bank follows by lowering the rates. So they're just tuning a dial based on some rules that they've set up, and they're just following. There's no evidence that what they're doing is creating the inflation or the disinflation. For example, and I mean, actually, first of all, I want to say, yeah, I've also run that correlation analysis, and there really is no correlation between at least. So there is no correlation between the notion of that raising interest rates reduces inflation and dropping rates raises inflation, but you could make the case that the opposite is much more likely, because when you raise the rates, you increase the net injection of free money into the private sector. Basically, the government is paying people with money more money. And when the rates are low, that is not so much the case. So if anything, raising rates could have an inflationary effect. I'm not saying that they do necessarily, because there's so many other factors that have much more relevant impacts on inflation. But if anything, the relationship should be inverse. And I mean, if we want to play this game of looking at these numbers and pretending we're scientific and all that, well, we see that rates are higher whenever inflation is high. And we see rates are lower whenever inflation is low, just like Professor Werner observed, except it seems to be more like the Fed just follows.
Right.
Whatever.
That's what I'm saying.
On.
The cause and effect is even backwards. Is
right,
that
right.
the the interest or the inflation goes up, and then the Fed runs over and goes, oh wait, turn up the dial, and then it goes down. They run over, they go, oh, turn down the dial. It's not.
Yes.
Yeah.
Exactly. And right now we're in that situation where the Fed has raised rates to these, pretty high levels by recent standards. And now inflation has started coming down, so I'm sure they're going to do a victory lap at some point around that. But there's really no proof that any of this was due to raising the rates or lowering the rates. I mean, what raising the rates does do is that it'll reduce asset prices in the economy, certainly, but that's not inflation or disinflation, because inflation is more concerned with consumer prices and producer prices. But certainly when the interest rate goes up, the net present value of your stocks and your gold actually as well goes down, right? Because now the company has to make so much more profits in order to compete with the free
money,
with the risk-free option, with the free money option. Like right now, you can earn over 5%, 5.5% or so on a money market mutual fund or on a treasury bill, basically on a pile of cash in your bank. You can make 5.5% right now, or 5% or something like that.
Mm-hmm.
And like 3 years ago, it was 0.1% or whatever. So the corporations have to compete with this alternative asset that we can put our money in by making even more profits than 5% or whatever. So then in the net present value calculation, all else being equal, the current projected income streams of corporate America are worth less if you can make more money in the risk-free alternative, which is money market mutual funds, savings accounts, etc. So yes, asset prices will come down when you raise interest rates. They'll also go up when you lower interest rates for the same reasons, just inverse. But in the consumer economy, this does not translate to the consumer economy, basically, because number one, when the Fed raises interest rates, there's actually on the net more money injected into the private sector. So you're going to see assets certainly adjust when unexpected interest rates increases happen, just like what happened in 2022, or throughout 2022, all the way through now. What was I gonna?
Well, while you're thinking about that, I wanted to point this out as well. So we're arguing that the increasing the interest rates creates a net injection of money from treasury bills paying more than they were before. Well, there's this counter argument that says, okay, well, yeah, but now that money has gotten more expensive, the banking system is going to create less credit because the money's more expensive. Well, that's not what we see.
Right.
I mean, we both listen to Mike Norman, and he's like checking it every day because you can get all this data from the Federal Reserve website, right? He's checking the data every day, and bank lending is going up at the same time that the Treasury money creation is going up.
Yeah, throughout this whole exercise of raising the interest rates, bank lending has gone up and up and up, with one exception, which is basically the banking collapses that they manufactured briefly for a brief month or so.
Right.
Which we saw with SVB Bank and.
Is that even an exception? Because we looked in detail at the balance sheet of the SVB Bank, or the first one of them. I don't remember which one, and they were killing it making loans.
They were doing fine. And then there was also First Republic Bank. It was certainly the problem was that the rates had increased so much beyond what they were earning. So the rates that they had to pay to depositors had gone up so much beyond what they were earning that the profitability model wasn't working out anymore. And that was obviously a result of the interest rate policy and the reverse repo operations. I think we've discussed that.
Yeah, and the reserve requirement, right? I mean, there's kind of this mosaic of regulations that had to line up in a certain way for it to happen, and they nailed it.
Right. So yeah. So what I was going to say is, while asset price, etc., may come down for a little while, what also happens is that there's now more money in the economy for more consumption and investment due to these interest rate injections, and those will end up showing up in corporate profits again. And I think that's kind of what we're going to begin to see now, because corporate profits are still apparently doing fine and have been doing okay. The U.S. economy has sort of muddled through for the past half year or so, because in part of these banking shutdowns and the fear that ensued. But the monetarist scenario of, oh my God, we're going to have a stock market crash because rates are so high, and the economy is going to crash because rates are too high, so far hasn't really materialized. And so that's another piece of evidence right there that the correlation doesn't really work out the way that mainstream economics teaches us.
Or again, even Austrian economics, because they buy the same right. story on this particular piece.
Right. I mean, we can, yeah.
So and we're still on point number 1 of the 5 points, right? So in general, like there's this major point that interest rates are the thing. They are the big thing that controls everything. And that's constantly what we're hearing from every direction. And they're just, I mean, it's not like they're wrong. Not just wrong about it. It's like opposite. It's the opposite of what they're saying. Anyway, moving on to number 2.
I mean, and also I just want to talk just real brief on inflation, right? So we saw this monetary bazooka basically fired at the economy after March 2020 during the lockdowns, etc. And we also saw the supply chain idiocy and the requirements, regulations, shutdowns, etc. All kinds of sabotage that was conducted on the economy, on the entire world economy, pretty much. So these things will cause prices to rise, but also the price increase will happen for a certain period until the prices have adjusted to this new equilibrium, basically. And then the pricing...
Careful with that word. I'm about to trash the word equilibrium on point number 2.
Well, I mean, it is...
I get your point. There's new conditions that needs to be adjusted to. Yes.
Right, the new conditions. I mean, the equilibrium is ever changing, right? So if it's not really an equilibrium in the ecology sense or whatever, but certainly while this was going on, we've experienced price increases, but it doesn't mean that these price increases. So once the price, the inflation has happened from one year to the other, doesn't mean that it has to continue rolling on like that. It's going to level off at some point, and that's, I think, what we're kind of seeing right now. We saw inflation reports coming in pretty lower than expectations, 3% now.
Yeah, we're finally catching up to the conditions that have changed, essentially.
Right. I mean, it's right. So the only reason why it would continue going on and accelerating more and more would be if we go into some sort of spiral where, okay, oh my God, the prices have gone up. Now the labor unions demand wage hikes, and then that in turn causes inflation. And the Fed raises interest rates aggressively more and more. I mean, it's fine where they're at now, but if they were to go higher and higher and higher, maybe at 10% or whatever, 15% at one point, that in and of itself will also contribute to inflation. So I don't think they did anything to stop the inflation. They've just played around on their dial while things were happening due to fiscal policy, due to supply chain policy, and now that is leveling off. And actually now, just to add to that, we're in a situation, because people always say, oh, inflation destroys all my savings. It's not really true, and I've argued this many times, that the interest that you get compensated for the inflation via the interest that you're paid to some extent, not always fully, not always, it's not always, it's not ever 100% correct, but sometimes we have inflation levels that are at, let's say, at some high level, but you have an interest rate somewhere below that, maybe that compensates you. However, now we have actually inflation lower than the interest rate that you can earn on your savings account. Or
right,
on
we
your
got 3% inflation according to the report. Now a savings account could do 4 or 5.
5%.
Yeah.
Right. So it could be maybe part of the Federal Reserve's policy, or some sort of unspoken thing, is just that they change these rates to compensate people with money for the inflation that they would otherwise suffer from in their monetary holdings. I mean, that could be, I guess that's not really something that they could officially tell people, because it would make a lot of people very angry. Why are you bailing out all these rich people? But that's kind of what's in effect, that's kind of what they're doing. And maybe that's why they watch this inflation dial so obsessively and tweak around on the rates. But yeah, it's not that they are affecting anything other than compensating people with money for the inflation.
Let's move on to point number 2.
Yeah.
So point number 2 is, and we're talking about the 5 pillars of the central banking narrative, according to Professor Richard Werner. The second is markets are in equilibrium around supply and demand pressures, and these pressures are measured in prices. So we've talked a lot about what we feel is like the core issue, the core problem with modern economic theory, and we've talked a lot about the barter theory of money, and I think that is one of the still core, but I'm also starting to think there might be a second part of that core, which is this concept of equilibrium. I mentioned earlier I was going to trash the word equilibrium, right? But it's this idea that ultimately comes from Adam Smith's idea of the invisible hand, and then maybe not even ultimately comes from the Isaac Newton's universe, which is what Adam Smith was trying to emulate with an economic model, which is that, okay, when you have prices and the government gets out of the way for the market to interact with itself appropriately, if there's a certain supply and a certain demand of anything, labor, corn, shoes, whatever, Ferraris, there's going to be an equilibrium where prices match to make sure that the supply is eaten by the demand.
Right. So
the demand is eaten by the supply.
Right. So the theory suggests. So yeah, the theory that you're trashing is that these prices adjust so that supply and demand can be in equilibrium, and that the market gets cleared, basically.
Right. And then
I mean, because I was saying equilibrium earlier in the sense that, if you throw money at people, you throw a lot of net private savings at the economy, then prices will go up to some extent. But that doesn't mean that
the dogma here is correct. Yes.
It doesn't mean that there's some sort of that there's an equilibrium in the sense of that supply and demand are brought into harmony, basically.
Right. Well, and then speaking of harmony is a good word.
They were that point. Sorry, just.
Oh yeah, sorry.
It's entirely possible for a free market for all actors, for all corporations in the market to be perfectly satisfied in a situation that is not at all in equilibrium. And I think that's something that neoclassical economics, and by extension also Austrian economics, cannot possibly fathom, because they have this, the supply and demand charts that perfectly match in their theory, in their perfect rational, pure reason theory, but it doesn't seem to work out empirically.
Well, and to further that, Werner mentions this, is that Not only are markets supposedly in equilibrium around the supply and demand pressures, it's that these markets will naturally maximize resource allocation as a result of automatic or natural price movements to make sure that demand equals supply almost all the time. And
or supply equals demand.
right.
Yeah.
And therefore, price analysis is the most important, prices are the most important thing to look at when it comes to economic analysis.
Mm-hmm.
Now, this is the part of the article that just cracks me up the most because Werner demolishes this idea. So basically, in order for there to be this equilibrium that naturally occurs with market forces, 8 things have to be true. Everyone has to have perfect information. There have to be markets trading literally everything. All markets are made up of millions of small firms that are competing so fiercely that there are no profits in the corporate sector, and there are no monopolies and no oligopolies, which is why we know that there are, Microsoft and Apple are just two among thousands of computer options that we have for selecting computers. Prices are constantly changing 24 hours a day to instantly reflect changes in circumstance, which is why there's no sticker prices at grocery stores, because that would take too long to change to reflect the constant changes that are happening. Number 5, there are no transaction costs. There's no fuel cost to transport things. There's no real estate fees. There's no broker commissions. There's no legal fees. None of that exists. Everyone has infinite time and infinite lives. 6. 7, market participants are 100% self-interested, which is why we know that no babies ever live. They all die of neglect. And finally, number 8, nobody is ever influenced by anybody else, which is why advertising doesn't exist.
Yeah.
And
yeah, I think. Sorry, go ahead.
Well, what I was going to say, particularly this last one, I think is one of the more easy ones to conceptualize, is that if the market naturally, adjusted to fit whatever the supply and demand curve was, that would mean we would all know what was going on, which would mean there would be no purpose for advertising. But obviously that's not true. And if advertising is a thing, we could be convinced of something that's not going on. Right? My advertisement isn't to tell you, isn't here to meet the supply and demand curve. My advertisement is here to sell as much of this shit as I possibly can. Right? So I'm actually, the advertisement is to create more demand than was there previously.
Yeah.
And then, the same thing with the broker and agent costs. It's like, okay, there's this constant flux. Well, that ignores that in order for that to happen, there's always players. I mean, even taxes are part of this, right? Every time you make a transaction, someone's taking out a piece. That's not the buyer or the seller.
Yeah, I think it's a good point that in neoclassical economics, they don't have a very sophisticated distinction of different types of pricing markets. For example, the stock market is a market kind of like what they're envisioning, right? Where there's no friction, there's always, every second we know what's going on. But that is a very different market from the candy bar market.
Or the luxury sports car market.
Exactly. Yeah. So the markets, the consumer market, in the consumer markets and producer markets as well, prices are very much administered from the top down. They're not some they're not the outcome of some efficient auction process. They are set and suggested by entrepreneurs with business plans who need to get loans for their business plan. And the most crucial component of their business plan is how much money they're going to make. And the most crucial component of how much money they're going to make is what prices they're going to charge for their product. That's why you'll find in almost any business plan, this is an important topic. What prices are you going to charge for this or that product that you're looking to offer? And so prices are basically crucial to even getting the business going in the first place and getting the loan in the first place. And now we're going to try to sell at this price, right? We're not, I mean, at some point, yeah, there's going to be competition, etc. But if we may end up in a situation where, okay, I guess this whole pricing thing doesn't work. The prices aren't just going to adjust to some lower level and things continue from there. The entire business might be shut down if the profitability model doesn't work out.
You just go out of business. And then he doesn't mention it here. I mean, he kind of alludes to it. But this 100% self-interested, rational human just doesn't even remotely exist. No. I mean, just as a anecdotal example of this. So I used to own a junk removal company. Like, if you've ever seen the Got Junk commercials, right? I had a smaller version of that. Still exists. I sold out to my business partner. He's doing great. But we would go out and clean out these houses and stuff. And sometimes you get some good stuff. And sometimes you'd want to keep it. And sometimes you're like, okay, this is good. I kind of don't want to throw it away. Let's try selling it. Or if let's just try to, sometimes let's give it away so we don't have to pay the dump fee. You know what we found out? It's easier to charge a price than it is to give something away. Like, we put it at something at the end of his driveway. If we had put a free sign there, it took longer for it to disappear than if we put $10 or $20 on there. Now, I think the psychology is pretty easy to understand. If you see a free sign, people go, "Why is that free? What's up? Why are they trying to give that away?" Versus, okay, there's a price here. Okay, I'm actually paying for something. But that easy psychology to understand does not apply to the 100% self-interested person who should go, free's better than $20.
Right. I mean, the 100% self-interest and especially 100% rational person. So that is a pretty wild assumption to make. And it's once again this phenomenon of autonomous man, right? Autonomous reasoning man can figure it all out and it's all going to work. We've discussed this in the realm of spirituality or whatever. Same applies in economics too, right? It seems like this model, that there's a model that is attempted to be applied to reality, and it just doesn't really. It
has nothing. It's not even close. Yeah. I have another funny anecdotal example. I got to get this one out. So I'm going to make fun of my mom, who deserves it. When I was growing up with my mom, when I take a shower, there was 400 bottles of like different shampoos and conditioners and shit in the shower. You know, I'd stand there and just be like, whoa. I remember as a kid, sometimes I'd be bored and I'd like mix them all together. My hair felt really weird after doing that. And I remember as a teenager, at one point, I brought it up to my mom because she came home with like some $50 something or other from getting a haircut or whatever. I'm like, you've got 20 bottles of stuff in there. Why are you buying this? And she said something to the effect of, it's really, these barbers are really, really good at marketing to women, and it's really hard for us to say no, which was like the most retarded answer that you could possibly think of. I'm not in control of myself is what I can't control my spending habits or whatever. But regardless of the specifics of my mom, is that a 100% rational action?
Well, yeah.
No.
So,
and then advertising works. Sorry, Cleveland.
Right, so, this is another thing, right? So is there any consideration for the difference between male and female, for example, in this? The consumer economy, it caters about 80% of consumer sales are to women. And why is that the case? Well,
does my story explain anything?
because women are incredibly embarrassingly at times, easily manipulated through emotional triggers. And people who are in advertising and PR absolutely know this and take full advantage of it, as we're seeing borne out in the stats. Now, what were we talking about before that?
Oh, the 8 points of why equilibrium is stupid. The 100% rational, self-interested person that doesn't exist.
Right. But I forgot what I was going to say.
Well, and then while you're thinking of that, I'll continue. So I mentioned that I think this is one of the core issues of economics, is this assumption of equilibrium. And as Professor Werner points out, there's no evidence that this equilibrium exists at all. There's no evidence at it at all, and it's like one of the core concepts of modern economics, or of economics in general, because Adam Smith, the guy who supposedly founded the science, right?
Economics.
This was one of his main ideas, the invisible hand. And no, again, like scientifically, no one's ever tested any of this except people like Richard Werner and the MMT guys who are like, wait a minute, the data does not line up with this at all. And Werner points out that what this means is that it's not equal power between the supply and demand side. Whoever's the short side, which is to say, whoever has less of the resource, whether that's money or whatever the thing being sold is, they have the power. If it's a short labor market like it is now, the employee has the power to choose employers. If there's more employees needed than labor, the business has the power to choose employees, right? And I think he makes some mention or something either in here or on one of his videos that let's say it's the latter situation where we've got many employees applying for one job. You know, if I got 20 interviews, I could ask each one, what's the lowest you're willing to work for? What's the lowest you're willing to work for? Right? And maybe that's not, at the end of the day, the thing that I pick as the reason for hiring somebody, but I have more power than the employee in that case, as the person hiring. Now, on the flip side, if it's, you know, I've got three businesses fighting over one employee, the employee can go, how much you willing to pay me? How much you willing to pay me? Did you remember what you were thinking of yet?
I think it was something on one of the points. There were 8 points. I'm just trying to find
perfect
them.
Information. Markets are trading everything. Millions of small firms. No monopolies. No oligopolies. Prices constantly changing 24 hours a day. No transaction costs. Everyone has infinite time and lives. Market participants are 100% self-interested. Nobody's influenced by anybody else, so there's no advertising.
Well, maybe what I just wanted, maybe it was just laboring the point of, the idea that you can build an economic system from an atomistic beginning. It's kind of like same with scientists looking at physics, etc. Right? Everything's supposedly these atoms, you know, these electrons, all these things floating around.
Disconnected atoms bumping into each other.
Starting from bottom up. So but I guess we've covered that.
Well, I do want to say this to end this point. So Werner points out that hiding this fact that the short side has power, can allow the short side to wield its power while simultaneously claiming to be virtuous for just participating in market forces. Hey, we're all equal here. I can hide the fact that I'm more powerful by saying, hey, we're all equal here, if this theory that is bunk is actually true. And here's a quote that I copied that I felt was worth reiterating. Thus, it can be plainly seen today that the most important macroeconomic variable cannot be the price of money. Instead, it is its quantity. Is the quantity of money rationed by the demand or the supply side? Asked differently, what is larger, the demand for the money or its supply? Since money, and this includes bank money, is so useful, there is always some demand for it by someone. As a result, the short side is always the supply of money and credit. Let me reemphasize that. The short side is always the supply of money and credit. Banks ration credit even in the best of times in order to ensure that borrowers with sensible investment products stay among the loan applicants. If rates are raised to equilibrate demand and supply, the resulting interest rate would be so high that only speculative projects would remain and bank loans portfolios would be too risky. So what he's saying is, if we try to meet the demand for all of the money, supply the demand of all the money, you would get all these bozos with half-baked business ideas getting loans, creating money, and more than likely defaulting on those loans. And because you'd have so many defaults, they'd have to hike the interest rate up to make up for the difference. But we don't see that. What we see is that they're very careful because we don't want to meet that demand in order to make sure that the majority of our loans are good, which, as Werner points out, this puts the power in the hands of the credit creators, which are the banks.
Yeah, okay. And that's also sort of along the lines of what we discussed the other day. Yeah, because it something I sort of speculated that might be the effect of forcing the banks to raise interest rates, right? If the Fed raises rates more and more, and the funding side of the bank's balance sheet becomes very expensive, they may end up getting forced into making more and more risky loans, because the safe loans don't even theoretically ever pay for the funding costs. But risky loans might. So, because rates can be 15, 20%, whatever. So the Fed raising interest rates might actually encourage some banks to engage in more and more risky loans, which is kind of the opposite of the intention of that policy.
Yeah, I completely agree. This leads us to point number 3, which we've now alluded to. The third pillar of the central banking narrative, and this is so asinine. If you've listened to the show at all, you'll make it go cross-eyed. Banks are just financial intermediaries. All they do is loan other people's money. Therefore, they don't actually have any use in like the economic models and the economic analysis. So they're not considered in the economic analyses because they're just loaning other people's money.
Yes. They don't exist in the neoclassical economic model, in fact, which is just
unreal.
It's incredible because they are the most important actors in the capitalist economy, and they literally do not exist in the neoclassical model. And the way that the neoclassical model copes is, as you just said, they're just basically called intermediaries. They're just, pass through, money comes through, goes in, comes out.
We can't explain where money comes from, but the banks are just loaning people other people's money. If that's true, where does the money come from in the first place then? So...
Right. We've talked about that, right? Many
yes.
times.
The
way it works, the way it actually works is that the bank makes a loan and that creates new money in the economy.
Right. For the majority of it, we've also talked about the government also makes money, but the majority of the economy's money comes from the banking sector.
Yeah.
I think generating loans is probably the proper verb to use for something like this. And yeah, I mean, this is what we've talked about ad nauseum on the show that we instantaneously recognize from MMT. But there is an additional point that Professor Werner harps on here that I think is very important to point out, is that there's two different main categories that you can create money for. The first one is productive businesses, and the second one is for assets. And an asset...
Three.
What's the third one?
There's also consumer credit.
Wouldn't that kind of lump into the asset category?
No.
For the sake of what I'm about to say. Well, let's see.
Well, sure. Yeah, for the sake of what you're about to say, same idea. It's an unproductive loan. But I just want to point out that it's a not insignificant amount of credit is made for consumption purposes.
Got it. So,
AKA credit cards.
Right.
That wasn't clear.
So if a loan gets generated, if money, I mean, I'm not going to say the word loan. If money gets created for the purposes of a business that's going to employ people and provide goods and services, you've created money while at the same time finding a way to use that money, right? You're employing people and you're putting more goods and services into the economy where that extra money has more things to buy, right? Now, compare that to a house or even consumer spending or a car or speculative stock investment. Is now, if we're creating money to buy houses, you're not making more houses by doing that. I mean, okay, maybe in some you're raising the price of the houses, which makes people want to buy more houses or whatever. But or actually, want to build more houses.
Unless it's a new construction.
But I would say that falls into productive business.
I think
that new construction.
I think so. I mean, even though at the end of the day, the house once again is a consumer object, right? But
now there's more consumer objects to buy.
Right.
Yeah.
I think a house is actually somewhere in between a consumer loan and a productive loan, because it's a very durable good, right? It is there for society to be utilized, and it can be used by other people down the road in the future. So you're not eating away at the house necessarily, even though there's wear and tear.
Now, are you talking about a loan for a construction or a loan just to buy the house?
A loan for the construction.
Yeah, I agree. Now, as a loan to just buy the house.
Yeah, now that's an existing asset. It's already in the economy.
Right.
And it's just changing owners. Yeah.
Right, and then if you start throwing more and more money on that, you're throwing more and more money to bid up the same number of goods.
Yeah.
Same thing with the stock market. Same thing with cars. Same thing with, I would argue, like you said, with credit cards, with consumption goods. Hey, I got a $10,000 credit card. Let's just rack that sucker up, buying TVs and shit, right? I mean,
yeah,
going out to dinner and stuff. So, yeah, I mean, it's the third pillar that banks are just intermediaries is just so asinine. It's like I don't even know how to.
Yeah, banks are the executives of the economy, basically.
Yeah, not the clerics.
Right.
So. Number 4, this is something that we've talked about a lot in our MMT conversations. The fourth pillar is that savings is required for investment into economic growth. And if domestic savings are too low, we have to attract foreign investment. This is just completely bunk because we create the money. It just doesn't make any sense at all. If the government can create its own money directly or by adjusting regulation, it can affect how the banking system is creating money, then we can create all the money we need to do anything. Particularly if we already have an advanced economy. Yes, there's an argument to be made if you've got a very primitive economy, you got to get money from advanced economies to kickstart things and get them going. But for an advanced economy, you don't need to at all.
Right, because there is this economic history model of, well, at some point we started generating surplus food and then we were able to do investment. There's some truth to that, obviously, right? In a very primitive economy that's hand to mouth every day, hunter-gatherer. And now suddenly you find a method to plow the fields and to remain in the same place and to grow a bunch of wheat to make a bunch more food than you can consume right away. Now you have the ability to spend some more time on investment goods, on whatever, irrigation, bridges, etc., temples, whatever. So yeah, that there's some truth to that in a very primitive economy. But I don't think that necessarily applies in an advanced economy anymore, where we know that we can have all the consumer goods that we want. In fact, we have so much, it's way too much. Oh, I know what I was going to say now. Because you were talking about shampoo bottles, right?
Yeah.
And, I absolutely hate the idea of communism, but I have found myself fantasizing about communism standing in the shampoo aisle at the grocery store.
Why? So you don't have a 400,000 selection?
Exactly. Give me one damn shampoo.
Because in socialist countries, you get the one that they make and that's it.
Right. Right.
No, I remember I went to Slovenia, and the people there, which was part of Yugoslavia back before the communist country collapsed when Tito Broz died. I remember them telling me, like, I remember after the collapse, things were different because, before the collapse, you'd go to the grocery store and, there's only one ice cream, and now there's like 4,000 ice creams. Exactly to Deepa's point. So, just to finish up the savings are required for investment.
What was the ice cream that they did have under communism?
I don't know. Well, I bet they had a couple flavors. It was just one company that made the ice cream, was the point that she was saying. So if savings are required, and if we don't have enough savings for investment, then we need to attract it from foreigners. This is an argument for having high interest rates. We need to have the interest rates high in order to attract foreign money to come here, which again is just complete nonsense. However, this argument is the basis for the World Bank and the IMF, which we know go in and in quotes loan money that gets squandered away in exchange for austerity. I mean,
guess who likes that theory that poor economies need to raise interest rates so that it's worth putting your money there?
Capitalist pigs with monocles that want to go in and glut out natural resources for free.
Right.
Yeah.
I mean, the IMF and the World Bank, they are basically the global banking system's socialized collection agencies. Right? They are collection agencies who collect money for the world's mega banks at no charge to those banks. So it's a corporate welfare policy towards the world's mega banks because they need it, right?
Right. Those poor mega banks.
Yeah.
Getting picked on. It's like, when James O'Keefe picks on BlackRock. Poor BlackRock. Big old mean James O'Keefe picking on him.
When people question the Pfizer fertility thought. Right.
Poor Pfizer. What are they going to do with such big meanies picking on them? Exactly. So, and then, with the IMF and the World Bank, they come in and they say, okay, here's this loan that you got to pay back at some exorbitant interest in a currency that you don't create. And so the only way for you to get it is to sell off these natural resources. It's just a big glutting operation that doesn't have to happen at all, because the whole thing of like, there's not enough money, so we have to run around and chase money, when in actuality money's this made up thing that we create out of nothing. It flips the story on its head. So we'll get into this when we talk about conclusions. With this story so obviously incorrect, this narrative so obviously incorrect, why does it keep getting pushed forward? We'll get there. Let's get the fifth pillar. The fifth pillar is that growth requires deregulation because only market forces can deliver high and stable growth. And this is the kind of the glowing, shouting thing from the Austrian camp, right? If we could just get the government out of the way, all the way, 100% out of the way. Maybe 99% if you're a libertarian, right? But if we just get it out of the way, the market could come in and fix things. And after I've read the E. Michael Jones, Bearer and Metal, the history between, or the conflict between labor and usury, the history of that, I now understand that this free market ideas were originally came out of England, Scotland and England, when England was the only country on earth that had gone through the Industrial Revolution. So it could create the cheapest products over anyone because they're the only industrial revolutionized spot on earth. And they wanted to go and encourage the free market everywhere else, which of course means no tariffs in this sense, so they could flood the local economy and prevent of another country, particularly Germany, and prevent that local economy from developing its own industrial revolution, so England could dominate the rest of the world. And what ends up happening, or what ended up happening and continues to happen, is that the proponents, particularly at the time, of this free trade concept, or this free market concept, which is to say, okay, government needs to get out of the way of everything, they only would say that when it benefited them. If it benefited them for the government to get in the way of everything, they were all for it. For example, if a government said, no, we don't want free trade, we want tariffs, they'll go, oh, well, let's take the government to send in the military to blow up the ports so we can force the free trade. Hooray! No more, like, now there's not any government anymore, right, to get in the way of the market. Like, it's just the actions of the people who have promoted this concept are completely contradictory to what they're promoting. And the reason is because it's a form of domination of competitors. It's all it is. You look like you had something to add to that.
Well, yeah. I don't know if people know this, but David Rockefeller, for example, right, the big state, industrial state, capitalist, monopolist, government, fingers in everything kind of family, he studied under Hayek, and he was pretty excited about these free market ideas. I mean, I'm not saying Hayek didn't promote free market ideas, but of course, people like David Rockefeller, they like to use these ideas when they benefit them.
But as soon as they don't, get the government right in. Yeah.
Right. So, I mean, also on that point, I'm all for free markets, etc. The thing is, deregulation of the banking system is certainly not the answer.
Well, and it doesn't make sense, as we've said multiple times on the show. That's like saying deregulate the military.
Exactly.
It just doesn't make any sense.
Right. So I think that would probably be one of the big things that libertarians would argue, is that the banking system needs to be deregulated because it's too overregulated. And our point is just that the banking system is the government, and the government
is a regulation. Yes.
The government can only function based on bureaucratic regulations. Ludwig von Mises wrote about this in his book Bureaucracy. So if you Austrians out there, the banking system is not a private enterprise. It's semi-private, but the government intervention plays a large role in this system. And if you allow this privileged organization that is the banking system, which has been given government privileges, such as creating money, then they're going to take advantage of it just like any monopolistic or bureaucratic individual would do if there's no restrictions on what they can and cannot do. So yeah, that doesn't work. Deregulating the banking system,
it's like deregulating
really
the military.
It
just doesn't make any sense.
Yeah, and David Rockefeller, I just bring up David Rockefeller wrote about in his memoirs, and I think Ayn Rand was dating a Rothschild. A lot of these, you have to look at what's behind and who benefits from these ideologies.
Well, and I want to be clear here. Let's
not necessarily. It's not necessarily a free market farmer, right?
Right. Well, and then let's be clear with our terms, because I can hear the Austrian ANCAP libertarian rumblings coming back at us. Right? Is that Nima pointed it out, and I'm going to put it in, I think, more clear terms. We're not criticizing the concept of trade without coercion. Right?
This is the memoirs. Boom.
It's fuzzy. Read the title.
It's David Rockefeller's memoirs.
Oh, okay. So we're not criticizing the concept of trade without coercion, right? Is that the term free market and free trade don't necessarily equal that, as I just mentioned, because when you have two separate countries, the fact that they're two separate countries using two separate currencies already means that in some essence there's kind of a tariff there anyway, right? Because I mean you have different markets based on the internal currencies and internal laws and all that sort of stuff going on. So to say, okay, well, this country should just trade with this country without any regulations or hold back whatsoever, because that is the least amount of coercion, I'm saying is not necessarily true. like for example, in the event of the English saying, okay, we want to go out and make sure that there's free trade everywhere, so we can make sure that the local country can't grow. How the hell is that not like force and coercion, right? So, and when we you pointed out that banking is a regulation and it doesn't make sense to deregulate it. Well, I can also hear the Austrians coming back saying, well, the government shouldn't be involved in banking and should not be involved in credit or in money creation. Well, sure, but you got to give me a theory that's not based on the barter theory of money.
Right. So we're open to that idea, and we've always said this on our show. We're open to that anarcho-capitalist banking system, but you cannot apply anarcho-capitalist concepts to the existing banking system in a nutshell, right?
Right. And the anarcho-capitalist concepts are all, sorry to interrupt you, Diba, but they all stem from, so I mean, they start from ethics, which I like. That's great. Non-aggression principle, self-defense principle, good. Once they hit economics and they take over the barter theory of money, they've accepted the equilibrium argument. And then they say, okay, ethical concerns will be addressed by the equilibrium argument once the government steps out of the way. Well, we just showed that the equilibrium argument is false.
And the barter theory of money
is false.
So there's some very foundational pillars of the business cycle theory, the Ludwig von Mises, the anarcho-capitalist world. They don't work at the moment.
Right.
You know? Now, we're all like, we've talked about cryptocurrency. We're super big fans. I've been involved in cryptocurrency since 2011. So we're not strangers to those ideas and those concepts and that whole world. But it is, if anything, it's a very it's a very novel system that needs time to develop, and we don't even really necessarily know what it would look like. You know, it's like David Graeber said, wrote in his book, Dead the First 5,000 Years. I'm going to be butchering it, I guess, maybe, but he said something along the lines of, anarchist economies have always been actually very uncapitalistic economies, very primitive economies. And capitalistic economies have all been created by states,
right,
by governments. So I think it's just important to consider that this ANCAP future that some people are envisioning
has no basis in reality.
But it cannot look like the industrial superstate capitalist economy. It would have to look very different than this economy. And maybe, it's certainly, I'm not saying that that is impossible. I'm just saying a lot of things that you're used to, you may have to give up and
reconsider. Well, and then again, start with non-aggression principle, self-defense principle, great. But once you step your foot into economics, you've got to go back to the drawing board. You have to completely start from the ground up, because there's no barter theory of money. I mean, there is a barter theory of money. We're saying it's not true, and there's no equilibrium.
I would say you shouldn't start from the ground, because that's what they've tried.
I'm sorry, they got to go rework everything. That's what I'm saying.
Right.
Yeah.
So I think, because I always love this part of this conversation. When we compare the philosophic principle, economic principles, spiritual principles, the whole revolutionary spirit that began in the 1770s, 1780s, etc., revolutionary France and revolutionary US, etc., they split off into three different groups: the communists, the libertarians, and the nationalists. And what all of these have in common is an Enlightenment anthropology, I guess you could say, of man, which views man as an individualized, atomized actor. And you can build an entire system from the ground up just through this pure reasoning from the ground up. And that is something we discussed in Rasmanyan's paper, that there's no such thing as reasoning from the ground up. And the people who think that they're reasoning from the ground up, they're deluding themselves, because everything you're doing assumes certain premises and certain worldviews. And so you're accepting a whole array of very fundamental concepts, even when you begin to ostensibly reason from first principle.
Mm-hmm.
So if the ANCAPs want to design a working system, they have to take into account what we have and what we have had for the past thousands and thousands of years, because you never get a tabula rasa in reality. You never really get a blank slate. You always have to work with what you've been given, if that makes sense.
It totally makes sense. I mean, this is what I tell people now who still argue this, is that don't tell me this new system that you're going to create when you don't understand the current one.
Right. Exactly.
I just want to throw this jab out there. I throw it out occasionally. The money regression theorem. That was Mises, right?
Yeah, I think it was Mises. I think it's Bim Bavak and Mises developed upon his theories, and that's the business cycle theory. That's what Mises did.
So with the money regression theorem, without even understanding what it is, the fact that that the term theorem is used should tell you a lot about what's going on here, which is what we've been saying, is that these people are in complete la-la land. Because a theorem is a mathematical concept. Theorems you don't even use the word theorem for physics, right? It's not the theorem of gravity, it's the theory of gravity, the theory of electromagnetism. Theorems are in a purely mathematical world, where we've created the boundaries and conditions. We can say, okay, because we've created the boundaries and conditions to be this, we know that this has to be true because we've created the boundaries and conditions. Well, we have not created the boundaries and conditions of reality. So once we move from mathematics to a science, I would say the first hard science from mathematics would be physics. Now things are theories; they're not theorems. So now, I mean, how many lines down the scientific, in quotes, purity scale do we have to go before we hit economics, right? Okay, we got physics, then we got chemistry, then we got biology, then we got psychology, then we got sociology. Then, at what point do we hit economics on that? To use the term theorem all the way down the purity level, so far removed from mathematics in the economics sense, is telling you one of two things, or maybe both, is the incredible hubris of the person coming up with it, saying, I came up with this and it's a theorem, or B, telling you that this is in a fake universe where we've created the boundaries, where we've defined the boundaries.
This is modern science in a nutshell, right? Modern science has created a system where it has become unfalsifiable. So this is part of the problem with Ludwig von Mises. His philosophy is rationalistic, and I don't mean that he's being rational or whatever. It's a philosophical,
non-empirical
term.
Yeah.
Yes, it's a philosophical strain of thought. It's a school of thought that was promoted by people like Immanuel Kant and I don't know, probably some other philosophers.
Well, I think you could pull it back to Pythagoras or earlier.
Probably,
yeah.
But Mises constantly he writes throughout his literature. He writes a lot about why is basically his cop-out is the variables of economics are so complex that empirical data is not useful for our understanding of economics. We have to start reasoning from first principle, and that's how he developed praxeology, and that's how this whole money regression theorem comes about, because these people think that they are starting from a self-evident axiom. And here's another thing that's problematic: the whole idea of self-evident axioms. We can probably get into it some other
different philosophical show. Yeah,
but that's what I see. That's what you see with this kind of stuff. This regression theorem, where he thought that, well, we all know that there was barter in the beginning, and
self-evident axiom. Yes,
right, self-evident, and then so then I guess, I mean, it's actually a pretty wild theory. I mean, I'm thinking, if I think first principles, Descartes maybe did a better job. You know, when he said, "I think, therefore I am." Okay, I mean, I'm not saying that I agree with Descartes on that or whatever, but Mises is talking about a very speculative field of economics, and he's coming up with some wild theories. And at the same time, his theory says that empiricism is too complicated, too messy. So empiricism can never invalidate my theory. My theory can only be invalidated by my own theory, which says that my theory is perfect and axiomatic and undeniably true. So this is part of the problem, that the rabbit hole you run into when you reason this way. When you ignore empiricism and you go with pure rationalism, you know, unadulterated reason, it leads to theories that may sound good if certain premises are accepted, but maybe they don't. Maybe they don't work in reality.
Right, and then there's no reason to test it, because we already determined that, well, it's too complicated to be tested.
Exactly. So if some empirical test delivers results that suggest that it doesn't work, then there was probably something wrong with your empirical observation, dude. Empiricism is messy. You have all kinds of variables. It's too complicated. I mean, it's almost kind of pathetic how Mises throws up his hands and says it's all too complicated.
Well, he throws up his hands and says it's all too complicated, yet somehow continues to insist being an economist.
Right.
Yeah.
Right. I just saw, when I shared this article about the regression theorem, I thought that they have updated it apparently and added something about Bitcoin here. So I thought it was kind of
read it.
Maybe fun to read. Recently, there's been a debate about applying regression theorem to cryptocurrencies such as Bitcoin. I guess I mean the regression theorem to cryptocurrencies such as Bitcoin. Since Bitcoin, for instance, is not backed by any commodity, it appears to fail the definition of a currency, according to the regression theorem. Others hold the view that Bitcoin does fit the definition, as it is at once a payment system and money, with the source of value being the payment system. Actually, I know who came up with that cope, because I saw Jeffrey Tucker's talk at the Bitcoin conference in Texas in 2013, I believe, 2013, maybe 2014. This was literally his cope. He was saying, well, I mean, maybe we can't trace it back to a commodity, but no, I have found the commodity that we can trace the payment system back to is the payment system itself. So I just thought it would be good to bring that, because
the reason my circular logic is correct is because it's circular.
Right. But our theory actually does explain, like MMT, we're probably the only ones who are able to
give yourself the credit, dude. You came up with it. I just repeat it.
Yeah. Who can explain with their theory the existing monetary system, the gold standard monetary system, and the cryptocurrency monetary system at once, which is basically the basic MMT theory, that some entity imposes
the creator demands the token. Yeah,
demands the token. In the case of the government, it's taxes. And in the case of cryptocurrency, it is the miners who demand a fee for mining Bitcoins, for the service of basically facilitating the entire crypto economy. And who pays the fee? Everyone who uses Bitcoin to send it from here to there. So you get that exact same beautiful circular explanation that MMT gives us for the fiat money economy, plus the banking system as well, considering all of that. And it can also explain why cryptocurrency has values for exactly the same reasons. And I've said it many times, if somebody, I even have a null hypothesis for this theory, right? If somebody can show me a decentralized cryptocurrency that can function without fees, that has value without any fees, then I would seriously have to reconsider this theory. But I haven't really seen such a thing so far.
Hell yeah. So, bringing this back to Professor Werner, and we hit these 5 different pillars of the central banking narrative, and we deconstructed them both with our understanding of MMT and what Professor Werner has in his own article. And the question now remains is that if it could be shown that this narrative, I mean, it's not just like a little bit wrong or wrong. I mean, it's like completely on its head backwards, not even in the same galaxy wrong. The central banks can't be completely ignorant to this fact. I've heard him point this out before in talks, is that the central banks have like infinite, not literally infinite, but for the sake of argument, they have infinite resources available to them in terms of money and smart people that they can hire to figure this stuff out. So either they're really dumb or they're lying on purpose. Well, I guess if you're lying, it is on purpose, or they're lying. He suspects lying. And here's a quote that I wanted to read from him. He says, this is from the article, as Forder from 2002 has argued, obfuscation has served central banks particularly well since they have become so all-powerful. The danger for them in this era of unprecedented powers is that the general public may simply and rightly link bad economic outcomes to bad economic policies by central banks, which is to say that the central banks might get blamed for what's going on, for the bad policies that they're putting forward. Not to the now far less powerful governments. In other words, since almost all economic keys have been handed over to the central banks, one can reasonably expect them to be blamed for the economic mess that is such a recurring feature of the economic policy during those decades of ever greater central bank power. As a defense mechanism, central banks could be expected to argue that they are doing all in their power to help the economy while pinning the blame on other actors. But for this to work, observers need to be misinformed about what the true levels of monetary policy are.
Levers.
Fuck you, Dima. I'm from America.
Well, you said levels, so that I just wanted to make it clear.
I thought you were making fun of the E. I meant to say levers. Maybe I'm Japanese.
Levers.
Levers. Levels. So this is exactly what I mentioned at the beginning of the show, is that if the truth of this narrative is obfuscated from you, or the truth of how it actually works is obfuscated from you with a narrative, you're going to pin the blame on the wrong actors, which allows the actual actors to continue the bad economic policies that appear to benefit somebody, and things can never be addressed appropriately.
Yeah, I mean, so much of governance today is just really about perception management of the population. I mean, that's what they're absolutely obsessed about, and not actually helping anyone. I mean, I don't know if anyone still believes that they have the slightest interest in helping the people when, I don't know, they have entire military brigades shitposting on the internet on behalf of the government narrative. Literally, I mean, there's the British government has whatever, something 77th Brigade or something like that, and constant talk about fact checkers and misinformation this and misinformation that.
They have to control the narrative.
By the worst liars on the planet. I mean, this is their project, right? Everything is so. Economics and helping people, etc., is totally in the background. It plays no role to them, and like you said, to them it's really like obfuscation of how the economy works. That's an asset to them. So that's what they're going to actually spend most of their time on, is obfuscating the entire situation. And that's pragmatism, right? It's profitable for us, so why would we do anything else? That's what
And
this philosophy leads to.
To lead off from that, I don't know if Professor Werner mentions it in this article, but I have heard him mention this in other talks. There is no reason ever for a financial collapse other than intentional. Because money's made up, right? So, I mean, we pointed this out, is that the economic model treats money as scarce. And that therefore price is the most important thing to chase around, and then we got to attract investment from foreign countries or whatever if we can't find enough money, or raise the interest rates or whatever the heck, right? Is that all money are like accounting adjustments in ledgers, and that happens by someone writing or typing. Like Warren Mosler often uses an example. If you go to a football game and a team makes a touchdown, and the person putting at the scoreboard types +6 to the team, and then wait a minute, they I'm gonna screw up my football terms here. A review, is that what you call it? If the team can ask for a review, and they turn out, there's actually a foul before the touchdown, so the touchdown didn't count. Okay, -6 points. Boom. There's nobody jumping up and down going, where did the points come from? Where did the points go? We understand this is someone typing something in on a freaking computer, right? That's all money is. That's all money is somebody typing stuff in, or, I mean, you go back far enough, someone writing stuff down on a piece of paper, or even more weird primitive terms with tally sticks and stuff in ancient
or
England.
or on a piece of gold.
Or a piece of gold. Very good. Thank you. So for us to go, okay, the reason we can't do it, and I'm talking about as a government, as a society, right? The reason we can't do it is because there's just not enough money in existence. Or, it's crashing because, that the central bank didn't have enough money, or that's all can be fixed by someone pressing a button. And so all these problems are from people intentionally pressing buttons the wrong way. And I know, that there's like the Austrian camp, or we'll call them the black pill camp or whatever, of let it all burn down and we'll start over. No, the system actually works if you press the buttons the right way. I mean, it's like my computer, right? If I, not that Control-Alt-Delete does what it used to anymore, but if I just sit there and hit Control-Alt-Delete all day, and go, my computer's not working yet because you're not pressing the right buttons. It works fine if you press the right buttons. I'm not saying we couldn't invent a better system, but the system we have right now actually works, and it would work fine if somebody was pressing the right fucking buttons.
Well, if people were more informed.
Right. If the people are more informed to put pressure on the people pressing the buttons to press the right buttons, yes.
Right, because burn it all down will not lead you to Ancapistan. It'll lead you more like into
Warlordistan.
Fascistan.
Yeah.
Or that, yeah.
And I mean, what we said it earlier is, okay, don't tell me how you're going to recreate the economic system when you don't understand how the current one works. And you particularly don't understand that it actually works pretty well if the right buttons are pressed. So, we hope this has been enlightening for you, that, I get asked this question a lot when I go at other shows, like, okay, so let's say all this is true, now what? Well, the same thing with anything. You want to know what the truth is so you can help base your decisions on it. Well, the politicians don't listen to us anyway. Okay, things are more complicated than that, right? Like Neba just pointed out, the most important thing for the ruling class to do is make sure that you don't understand the way things work. So if that's like where they put almost all their energy to make sure that you don't understand how things work, maybe it's a good idea that you understand how things work, and that might foil their plans a little bit. So you're welcome for helping you understand how things work.
Yeah, I mean, definitely psychological manipulation is really the only science that's being practiced, and that I can, from a purely neutral perspective, from a purely amoral perspective, I can admire actually what they're doing to manipulate such swaths of people with such completely idiotic ideas. That is I guess that is the final achievement of modern science. That's the culmination of science. It's stopped actually engineering stuff that's useful and helpful for us and completely obsessing about how to manipulate the minds of mostly women, but of a lot of society.
I wanted to end on something if I could find it. I'm not going to find it, am I? The comic I read, SMBC Comics, when it comes to this sort of thing, I find him absolutely hilarious. I can't find the comic right now, but I think I can describe it. Where anybody who has watched the Discovery Channel, I would say for the last 10 years or 20 years or whatever, I mean, it's all this like, you know, ancient aliens and I guess a lot of ancient alien stuff. I mean, what's that famous meme of the guy with the hair that's like looks like Kramer from Seinfeld, where he's going like this and it's like aliens. Here's the expert that we found to bring on aliens, right? And there's this guy. So the comic is there's this person working for the Discovery Channel, and this person criticizing them for, you guys used to talk about science, and now you have all this crap of like dinosaurs of Atlantis and all this sort of stuff. And the person working there starts describing what they're doing is A/B testing on people to figure out. I forgot to figure out what shows they're watching or how to influence them or whatever. And so, and then the other person has this realization. He goes, "Wait a minute, You're not. Your purpose isn't to talk about science. Your purpose is to do science." And the guy working there goes, "Well, yeah. What do you think we were doing?"
Yeah.
to Nima's point, right? The only science is actually being done here is what was the term used? Psychological.
It's psychological manipulation.
Psychological manipulation.
Psychological
science.
warfare. Exactly. I mean, yeah. It's like the state of science at this point is so pathetic in the world, and Peter Thiel actually gave a talk on that. Peter Thiel is a pretty successful investor and a philosophy major as well.
I found it.
Yeah.
Go ahead, keep going.
Yeah. He gave a talk on the sorry state of science today. So I'm just mentioning that to point out that there's actually somewhat mainstream people who are now doing like a post-mortem of what happened here. And ironically, it is exactly what Russ Mannion predicted in his paper about pragmatism. Like the whole empirical autonomous reasoning project has culminated in let's do what's profitable, let's do what benefits us, let's do what makes us powerful, let's do what makes us rich, etc. And as long as the cost calculation works out in our favor, then the profit calculation works out in our favor, then let's do it. Why not? There's no external morality from the human mind, supposedly, in that view. It's all basically what's the most profitable, and if it works for us. Nuclear bomb works too, right? For somebody.
Works great.
But
it let me conquer another country. Perfect.
But it's just completely void of any moral component.
Absolutely. So I was going to show this comic, but as per usual, I can't figure out how to get my own screen share to work with OBS and Zoom and all that sort of crap. So I think this wraps it up, Nima. This is a topic that we love to talk about, and I mean when you really see how off base the mainstream economic understanding is, and its supposed challenger, Austrian economics, which from our view we can barely distinguish them anymore. And you start learning how the actual economics work. I mean, first of all, you understand the truth, and that helps, and you can see clearly. But second, it helps you understand, okay, here's how I can interact in society better to help myself thrive, right? If back when I was wearing my Austrian economics hat, I was ready for the financial collapse to come at any given second, which influenced the decisions I made to say, well, there's no point in me, trying to earn a bunch of money and save a bunch of money and buy a house and do all this sort of stuff because it's all going to go up and collapse any second, right?
Right.
So when my outlook completely changed, I can say, oh, the banking system works in a way that I can actually utilize it to my benefit. Well, then, and then it's not going to collapse tomorrow because the Austrian description isn't actually true. Well, maybe I'm going to change my behavior based on that. And I did.
And here we are.
Cool. Well, this has been Dylan Moore and Nima Majur of IRETA TV talking some awesome economics. Please feel free to pick economic fights for us on other shows because we really enjoy going on other shows and talking about this stuff because you always get to the point where the person fights and fights and fights and fights and fights and suddenly go, I got to think about this more. That's when you know you got them. When you get the I got to think about this more. So we appreciate you watching and we'll see. Oh, check out more of our stuff at ireta.tv. Check out our Forbidden News aggregator at dissentwatch.com, which is getting cooler and cooler. And follow us at the social media of your choice. Please like, share, and subscribe because we don't ask you for any money. So please proliferate this as much as possible. There it is, Dissent Watch at dissentwatch.com, aggregating the web's most forbidden news. What's the most engaging post of today?
Most engaging post today is Libs of TikTok exposed Fort Worth school district for carrying the pornographic books Genderqueer and Flamer in middle school libraries. The school has announced that those books will be removed.
All right.
But I just wanted to demonstrate a new feature that we've added to Dissent Watch, which makes it much more dynamic and useful to the reader, I think, because you can now, at one click, you can get the most engaging, most popular, most discussed, most viral, most zapped, and most recent posts, which I think is very helpful.
Yeah, it's a great way to organize the vast quantities of information that's on that site.
Right. Because it's a lot of info, but this gives you the most popular, most discussed, so it gives you a nice little overview of what's going on right now, and the week, and during the month, the year, all time, etc.
Good. Okay. Thanks everybody for watching. We'll see you next time.